ECN listeners, this is your weekly FX update brought to you by Real ECN. Today, weekly commentary will explore the Euro-dollar market. Technical indicators turn bullish on the single currency as analysts forecast a corrective rebound in the Euro-dollar pair this week. However, the extent of this rebound is subjected to this week's major risk event, which included the Fed's meeting as well as ECB's LTRO program. This commentary will be broken down into two components. The first component is the technical aspect of the Euro-dollar market, followed by the fundamental component of the Euro-dollar pair. So firstly, we will explore the technical aspect of the Euro-dollar market. The later part of last week's trading session appeared to show that the single currency is bottoming out and in preparation of a correction to the upside. Currently, the pair is trading between the 14.6% Fibonacci retracement at 1.2981, which formed the resistance ceiling, while the 50% Fibonacci expansion formed the support tier at 1.28637. In the case that the pair can break above the 14.6% retracement, this will expose the pair to the next resistance tier at 23.6%, marked by 1.30568. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, open retail long and short position has converged. Currently, as the Euro-dollar pair is trading near multi-month low, last week bottoming in the price action has traded weighing in a neutral undertone, undecided which direction the pair can swing next. Nevertheless, a pickup in short interest will leave analysts in favor of further rally in the Euro-dollar pair. Currently, net retail long to short interest is sitting at a ratio of 1:1. Analysis of a collection of technical indicators on the hourly time interval on the Euro-dollar cross is suggestive of a temporary bullish market sentiment and recommend long positions on the euro. The Euro-dollar cross opened today's Sydney trading session 1 pip below the established Fibonacci resistance at 1.2958, while the Fibonacci support is set up at 1.2936. Since the Euro-dollar correction to the downside, the pair has managed to break above the 200 days simple moving average during the end of last week's trading session. Therefore, this is very indicative of a long-term bearish outlook on the cross moving forward, and if it cannot hold above the 200-day simple moving average. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today Sydney trading session above the 5, 10, 20, and 30-day simple moving average, which is indicative of a buy recommendation on the moving average front, on the short-term moving average front. So moving along to the fundamental component of the Euro-dollar commentary. Since the ECB announcements of further aggressive easing plan of action, the appeal of the greenback so far this month has held precedent over its demand for the single currency. On top of that, geopolitical tension overseas has worked to add value to the safe haven status of the dollar. Unlike last week, this week is packed for a market-moving risk event that is bound to induce a certain degree of volatility in the Euro-dollar market. Technical indicators are optimistic on the single currency, anticipating a corrective rebound in the pair as investors await this week's risk event to support the materialization of a rebound. The most volatile risk event this week will surround the Federal Reserve meeting. In line with expectation, the Fed is expected to hold true with the continuity of its tapering program more than ever. Investors are closely monitoring Yellen's rhetorical to see whether the chairwoman will downplay recent improvement in U.S. leading economic indicators, or hint a time frame for a rate hike. Most likely, the Fed will hold on to its doctrine on keeping interest rate low for an extended period of time after tapering. However, a hawkish revision in the language could limit the scope of the Euro-dollar rebounds. In the absence of a clear guidance in monetary policy, this would only work to build up a corrective momentum in the single currency. This week is packed for a market moving risk event out from the US. Starting the week off, investors can expect the release of US industrial production month-on-month print to come in at 0.3%, while on Tuesday, US core PPI month-on-month is forecast to expand by 0.1%. In addition to that, the US PPI month-on-month is also forecast to come in at 0.1%. On Tuesday, US core CPI year-on-year report is expected to roll out at 1.9% expansion, while its core CPI month-on-month print is forecast to come in at 0.2%. On Thursday, US building permit is forecast to come in at 1.045 million, while the Philadelphia Fed Manufacturing Index is expected to tick in at 23. Over in the Eurozone, the most influential risk event that was surrounding the Euro-dollar market this week is the ECB announcements of its LTRO program. Technical indicators all support a rebound in the single currency for the week. However, long-term recovery in the single currency is more difficult to forecast since the ECB announcements of its interest rate cut at the beginning of the month. Since ECB benchmark rate is at record low and couldn't go any further, the return of bearish buyers on the single currency would come in the form of a weaker demand in LTRO auction, coupled with a more hawkish Fed language revision. Nevertheless, there's a numerous number of worthy risk events out from the Eurozone this week. On Tuesday, investors can expect the release of German ZEW current condition expected to come in at 40, while the German ZEW economic sentiment is forecast to tick in at 4.8. On Wednesday, the Eurozone CPI month-on-month print is forecast to come in at 0.1%, while the CPI year-on-year print is expected to tick in at 0.3%. Wrapping up this week's trading session is Friday. German PPI month-on-month report is forecast to contract by 0.1%. I want to thank all our real ECN listeners for spending the time with us, and have a successful trading session, everybody.